Welcome back to Be Rich. After Namakkal, my team decided to do an event in Vellore. We have familial connections with Vellore. My father went to college in Vellore. He attended the Wooders College. So we are doing an event in Vellore on the 20th and 21st of July. Those desirous of attending this event should contact the WhatsApp number given below and send a message to the Gmail ID that is also given. Try to call as early as possible to avoid rush and disappointment. Because in Namakkal, we had to decline a lot of people who wanted to attend the event. Once again, I thank you for supporting BRIDGE.
Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about the advantage of being a small investor who invests for themselves and their family. And this is a topic which we thought that would be useful for all of you at home, especially those of you who don't understand how much of an advantage you have over the rest of the market by being a small investor rather than an institutional sized investor. Because the general consensus is that institutional investors have a team of research analysts who can do things for them, and they have a lot of money which they can supposedly put wherever they want. This is the general idea of what people think of a professional money manager. And the commissions you get are quite good. Well, that part may be true, but today I'm here to burst that bubble and talk about why it's good to be a small-time investor. So, Warren Buffett in his 2013 Berkshire Hathaway annual report talked about how the goal of a non-professional investor should be to own a cross-section of very good companies or decent companies that in aggregate are bound to do well. It shouldn't be to pick amazing winners, but rather to pick solid companies and own a cross-section of them and have an aggregate of them, not one, not two, many of them, and keep them in a nice portfolio which you keep adding to whenever the valuation looks right. So this is what Warren Buffett talked about in 2013. And the easiest way to do this is to take an index like the Nifty 50, or because we're B-Rich and we're talking about global markets, the S&P 500 index, which is a brilliant opportunity for most people to own a cross-section of America's top 500 companies. And another important point to remember is that Albert Einstein also said that the eighth wonder of the world is compounding. And he's very famous for talking about compounding. And Warren Buffett has also said that he who understands what compounding is will earn his keep in compounding terms. And he who does not understand compounding will pay it in terms of compounding. So what he means to say is that the opportunity cost of not learning about compounding is huge. You're losing a lot of money and you're losing it at a higher and higher rate as time progresses. Whereas the advantage of knowing compounding and engaging in compounding is that you make a lot of money over time. And the easiest way for us to compound is to accumulate using index funds and do dollar cost averaging. Dollar cost averaging in simple terms is basically when you have a fixed amount of money, let's say $100, which you invest per month for years and years. And whenever the market becomes overvalued, you buy less of the market with that $100. And when the market becomes undervalued, you buy more of the market with the same $100. So over time, your average price which you pay for the market averages out to a decent amount, which will give you handsome returns over a few decades. And most investors have in consensus agree that most exceptional investors agree that it would be hard to be poor if one saves 10 to 15% of their gross income, which is before taxes, and dollar cost averages it into the S&P 500 over a few decades. And this applies for when your income is near the median amount or a little bit above the median amount. If you're below the median amount, you might have to save a little bit more because your expenses aren't really covered by your income quite well. So you need to save a little bit more. But if you're at the median level or above the median level, which is the midpoint in terms of income, then you can definitely save close to 20 to 25% of your income, gross income, and dollar cost average it, and you're going to make amazing returns. Okay, we know this. But the point of this video is for the active investors. What about the enterprising investors, according to the intelligent investor, who want to make a little bit more money than just investing in the S&P 500? And we know that Mr. Market is a manic depressive character who suddenly pushes up stock prices and then tomorrow sinks it without any reason whatsoever, or any supposed reason, or for the tiniest and tiniest of blips. We see that the Mr. Market decides to sell things rapidly, and Mr. Market may not decide to pay what a share is worth for a long amount of time, or he may be demanding a lot more. So we know that Mr. Market is irrational, and we know that we can always look for a good deal from Mr. Market on most days, either selling to him when he's paying too much or buying from him when he's selling it for too little. That being said, then the question becomes for the small time investor, why not trade? Why don't we just trade in the short term and play Mr. Market and take his money, take his lunch money basically? It's not that easy. So Mr. Market, yes, he is a manic depressive character. He has episodes of irrationality. However, it is stupid to think that Mr. Market is wrong all the time, and is moreover stupid to think that Mr. Market, although we personify Mr. Market as one character, it's actually a combination of different characters. And you, if you're trading, day trading, or even trading by month or weeks, you are competing against other enterprising traders such as yourself. So you are competing against someone who is like you, who has access to the same information you have access to, and they are actively trying to get the better of you. And you will certainly have people like institutional investors who are based on short term. Like it or not, even institutional investors who say they're invested for the long term are people who try to forecast in the short term, because their incentives, their packages, all of it is tied to short term performance. So it pays for the institutional investor to hire a team of 10 research analysts like myself and get very minute information, granular information on the performance of certain companies. For you to think you can do better than these institutional investors is very difficult. It's almost impossible, because they have more resources than you on the short run. So for small time investors to beat institutional investors at their own short term game is almost impossible. However, and Charlie Munger says this, Charlie Munger says that it's not supposed to be easy. Those who think it is easy are stupid. Of course, Charlie Munger has a very incisive way of commenting, and we appreciate that. But for most investors at home, it's a cautionary tale. But where do you as a small investor have the advantage? That is the question which we seek to answer today. And if you look at the place where you have the advantage, it's known as a time arbitrage. Time arbitrage is when you can hold a stock for a longer period of time than an institutional investor. An institutional investor needs to make money today. An institutional investor needs to make money by the end of this year. You as a small time investor can go on with a negative portfolio for a long amount of time. If your portfolio is in losses, you don't need that money. You're investing money which you don't need, and you can hold on to those losses for a long amount of time. No one is going to come knocking at your door saying that, look, give me back my money. I trusted you with it, and now you're in a loss-making scenario. Yes, certain companies may take a long amount of time to show the returns which you want. That doesn't mean you are wrong. It just means that you got there early and you have opportunities to keep buying and adding to your position. However, the institutional investor will be kicked out of most investors in his fund will be asking for reasons to why his fund is underperforming year by year. But you don't have that problem. So what you can do is you can buy in the current market, and you get to hold it for the next 5 to 10 years and have wonderful performance over the years. When institutional investors have to dump it if it doesn't perform well, and they have to keep chasing performance, and they're going to be chasing the same stocks which other institutional investors are chasing, and you basically are stuck in a rat race with them when you don't have to be. You, on the other hand, can end up investing in stocks and companies for the long run. You can invest in a company which you think is of value today, which is trading below intrinsic value, and you are not in a rush for it to appreciate to its intrinsic value anytime soon. And let's say most of the companies which we have talked about on Be Rich or in MoneyPechu have had this intrinsic quality of taking some time to get to where it's supposed to be. The market doesn't, Mr. Market, being a manic depressive character, doesn't wake up and immediately recognize where he went wrong. It may take a couple of years for Mr. Market to realize he went wrong by selling you something very cheap. But once Mr. Market realizes that he went wrong, you can swoop in and make money when Mr. Market corrects his valuation. This is the advantage you have as a small-time investor. And it's very difficult for a small-time investor to have specific industry knowledge in any industry which they're not a professional in. And even those who are professionals don't have specific industry knowledge when it comes to investing. So it takes a lot of time and effort to be acquainted with different industries, and you will never be able to be as acquainted as a professional money manager because he has too much resources compared to what you do. So to compete with him in the short term makes no sense. You have to compete with him in the long run, and you will beat him by miles and miles. What do you think about this idea?
I agree with what you're saying. And even if you take this strategy, what you rightly said, then let's say we are laymen, we do not know anything. And why Warren says buying quality stocks and holding them for long term, you'll get great rewards by just doing that. Simple reason, if you take, let's just say, the telecom sector. 10 years ago, that's around 2014, let's say you looked at the best companies as a layman, brand-wise. Reliance Communications was there.
Tata Docomo.
It's Tata Communications. And then you looked at Airtel, and you looked at Idea, Vodafone that is. And you said, okay, these are the brands which I know. These are all big brands. And you bought 10 shares of each of these, and you waited, like Buffett said, for 10 years to see what happened. Yes, Vodafone would have bought it probably at 100 rupees, 120 rupees, and would have been wiped down to 16. Would have bought probably Reliance Communications would have been wiped down to 0. Almost. But at the flip of it, Tata Communications, you would have seen it go to 1,200 plus, or whatever it is right now. You would have seen your Airtel, which you would have bought around 200, 300 rupees, shoot up well past 1,000. So if you see the averages, that whole sector, which as a layman, you picked the top brands you thought and you invested in, net, you would have stand to gain. And this is what averaging means. Instead of looking at individual companies and individual things too critically, because you're a layman, you don't understand. You take a broad approach and take so-called large cap companies in a specific sector and take the brands which you know, and you start investing little by little. Not like dumping 15,000 shares or 8,000 shares. I'm not asking to swoop in and buy like that. You buy small, like Anand says, in Tiffin Coffee, and you keep accumulating over the years. As you saw Reliance, what they call faltering, you would have not bought Reliance anymore. You probably would have sold your holdings even if it was at a small loss. You would have exited Reliance a long time ago. Same thing is true with even if you were holding Vodafone also like that. You would have seen your holdings not looking great. You would have probably exited Vodafone too and consolidated more into Airtel and consolidated more into Tata Communications. Just as an example. And you would have gained more and more on these. This is a simple example of what Warren is saying. That you don't really need to know like an analyst, like being an institutional investor, having analysts at your aid. By just taking simple approach and being patient. The trick is holding it for the long term. Because when you're holding it for the long term, you will tend to gain. You need to only be an analyst if you're playing hot stones and you're jumping from one hot stone to another hot stone trying to move forward. Instead of that, you sit and you wait for the water around you to rise. You'll start floating up, regardless of what is there around you. And I agree with this. And it's a great bit of advice. The problem is human psychology gets in the way.
Yeah.
And hardest thing to do is to hold your wicket. You see this in test match very famously. One of the reasons why Anand loves Sunil Gavaskar so much is because Gavaskar, when India was falling all around him, would be able to hold on to his wicket. Yes, it may not be entertaining cricket, but to draw out a game is a tremendous thing, especially with a team like the West Indies in the 1970s and 80s, where you had hurricane wind speed balls being hurled at you to hang around there in the other crease and just keep knocking the ball down dead. That is a tremendous skill to have. It may not be glamorous. It might not be great to watch. At the end of the day, you save the game and you save your wicket and you make sure the team doesn't lose, which I think is a great thing. That way, value investing doesn't look sexy. It's not something flashy. It doesn't make great for social media and it's not clickbaity. And I understand that. But we're not here to do that. We're here to make money and wealth over a long period of time and secure your future and have less anxiety when it comes to about your finances. And I think this is one of the best ways to reduce your anxiety in the long term. By investing like this and staying invested, your anxiety levels will slowly start decreasing exponentially towards the end as your returns start coming in huge numbers.
As long as there's nothing fundamentally wrong with the company which you're buying, I don't see any reason for you to jump out of it in a rush.
Yeah.
Maybe you can take some time to assess whether the company is really in a downward trajectory or if they just had a bad time because the sector is cyclical or whatever the case is. And if it's a temporary blip, you can even consider adding some to your position in that particular company, because institutional investors are probably dropping it like hot potatoes. which is when you get a chance to, pick it up for a bargain, even though it may not do well in the next year or even 2 years or 3 years.
And the important thing is you should be buying in terms of PE ratio and not price. So that's where the value is. It is not in price. So don't get fixated, because the news is always about stock price. When you're searching for a stock, what first comes is your price. You'll be far better served if you change your screener stock tracker into giving you first the PE ratios for the day, if the PE ratios have moved, rather than the price movements. Because what you want to do is buy close to the median PE for 10 years or lower than that. You don't want to shoot way above over median. Let's say the median for this company, which I've been looking at, let's say 25. And today the PE is trading at 45. It's way out of need to buying it, because simple reason, it's trading way above what it usually is at. At the same way, if it's with average is 25 for 10 years and it's trading at 26, 27, okay, maybe a different coffee range. If you really want, you can look at it. But the trick is to keep looking at the value and make sure whatever you're buying has value. If it's no value there and this market is exaggerating the value, then you're better off waiting. Anything else you want to add?
No. So that's pretty much it. Just to sum up, please dollar cost average, which is basically indexing. Please invest a fixed amount, the kind of money which you don't need to survive right now. It's the kind of money which you can afford to keep or even lose 100% of. Please keep that for investing. Please invest. If you invest at least 20% of your gross income, if your salary is above the median amount, that itself is enough for you to be able to live a comfortable retirement life if you have a long enough runway. So please keep this in mind. Please don't panic. Please take it easy. And thank you for watching this video. If you enjoyed it, please like and subscribe. And please leave a comment below if you have any suggestions. And please forward it to your family and friends if they think they have some value to gain out of this video. Thank you.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.